Hey everyone, Szoldra here with the Szoldra team. I'm here to interview Brian Smith, who's a mortgage broker with Mortgage Architects. Just to give you guys a little bit of insight and some information, I know there's some discussion about changes on interest rates. So I thought we would answer some basic questions for you. Brian's been in the lending industry for 20 years with various successful roles. He was involved in the development and promoting of alternative mortgage products at First National. He's also been part of managing an underwriting team. And he worked as a mortgage planning specialist at IG Wealth Management, where he assisted financial planners and their clients in choosing the best strategy for their lending needs. Brian's very passionate about helping people and finding tailored solutions when it comes to lending. And whether you're refinancing or buying your first home or tapping into equity to purchase another investment, Brian will find that solution for you. So welcome, Brian.
Yeah. Thanks, Steve. Thanks for having me today. Looking forward to our conversation.
Awesome. So I'm gonna start this off with a nice little soft question for you.
Okay, good.
What's a basis point?
Right? What is that? What is that silly thing? Basis point. It's an increment in the interest rate, basically. So if somebody says, we think rates are going to go up by 25 basis points, that doesn't mean 25%. It means 0.25 increase in the interest rate. So a basis point is essentially a 0.01 percentage point increase in interest rate.
Excellent. So that's going to help move along the conversation if we go into down payment now, right? There's a lot of questions around down payments and how much you need to put down on a house. So, let's start with it's first time buying a house to maybe a little bit more of a complicated situation of, an investment property or second home.
Right. Yeah, so it's a great question. A lot of people think, hey, if I currently own a residence, my primary residence, I'm thinking of selling it, and I'm buying a new property, and I've got to put 20% down on that new property. Well, theoretically, no, you don't. You can put still 5% down on your next principal residence. So that's one of the misconceptions out there. One thing to keep in mind with regards to minimum down payment is it is subject to the purchase price and the size of not the size of the property, but the price of the property that you're buying. So it's basically 5% down is true, but it's capped up to 500,000. So if you're buying something for 700,000, it's 5% of the first 500 and 10% over above that to a million or 999,999, right? Yeah. Once you get to a million and a million plus, that's when it kicks in. You have to put 20% down because CMHC, Sagen, and Canada Guarantee are the three major default insurers in Canada, and they will not insure a purchase price of over $1 million. So that's why you have to put 20% down.
Okay, so if I'm a first-time home buyer or transitioning principal residence, I could put between 5 and 20% down, depending on if I want to avoid CMHC or if, whatever my situation is. So, okay.
Correct. Yeah, it would be different. Every situation might be different, but yes.
And so if my principal residence is over 20%, then I have to put 20% down. Oh, sorry, over $1 million, I have to put 20%.
Correct. That is correct.
Okay. What other instances would I need to put a 20% down payment on?
Well, it could be the fact that you don't qualify for less than 20% down. So it's forcing you into putting 20% down in that particular case. Or if you're looking to buy an investment property. So if you're looking to buy a rental property, then you're looking at a minimum of 20% down. There's no high ratio default insurance in the rental space. So you have to put 20% down in those situations. It could be property based in some situations where the default insurer is not going to insure a particular type of property. So you may have to look at putting 20% or more in those situations as well.
Okay, excellent. So another topic I think would be great to get an answer for is the difference between pre-approval and pre-qualification. I get asked this often, and as people know their realtor should be asking them, are you pre-approved?
Right.
So maybe you can explain the differences between the two.
Yeah, it is. It's another good one, and it's pre-qual. I would say be careful, right? And the reason I say be careful with a pre-qualification is that file hasn't been, or your information really hasn't truly been underwritten. And underwritten means essentially just assessing risk, right? That's really what the definition of underwriting is just assessing the risk. And in a pre-qual, it's basically just numbers put into an algorithm, a system that spits out a pre-approval number to you. And what is that really missing? Well, it's one thing, it could be human error, right? If the applicant is putting in income information that they think is right, but maybe not utilized by the lender. And a key example of that is for a self-employed borrower, right? They may be putting in their gross business income that they made for the year, when in essence, a lender is going to be looking at what do you declare personally as your income. So that number could be wrong, and that'll totally skew the numbers off entirely, right?
So it's like, okay, I made 100 grand this year, but I had 40K in write-offs.
Right. I'm only
so if I'm putting in my own numbers, I'm going to be like, yeah, I made 100 grand last year, but
right.
A lender would look at the after write-offs, right?
And that's not fault of the client. It's just that they're putting in what they think they made, and that's fair. And that's why I think doing a pre-approval, first off, as myself, I do full underwriting on pre-approvals. I'm checking the credit. I'm pulling a credit bureau. I'm verifying their income and employment. I'm also verifying their down payment and where is that coming from. They have historical savings built up. So I really want to do a full analysis of the file, not only to give them a hard number of what they think they can qualify for, but to guide them and coach them to maybe help them getting pre-approved rate maybe more down the road, or just getting pre-approved in general, because there may be some issues that we've identified in the credit bureau that we can help the individual fix up down the road. So the key difference is one is being really looked at, and it's more of a trusting number, I would say, than a pre-qual is just it's just basically a number spit out by a software program. There's no human component to it.
Excellent. So now to get to the meat and potatoes, there's been a lot of talk about interest rates. So
100%.
People want to know, how is this going to impact the real estate market? How is this going to impact my ability to purchase a home? Mm-hmm. So I guess we'll start with the biggest question that I hear. I want to get pre-approved and lock in a rate because it's going to affect my affordability. Mm-hmm.
Yeah, it's a good one. Another kind of misconception, I guess, in a way, right? A lot of people, like you said, Steve, they're rushing out there because they're hearing rates are going up. So they're saying, hey, I got to get pre-approved now. Let's get pre-approved now because I don't want to qualify for less when interest rates go up. Well, first off, rates have already gone up in a sense. 5-year fixed rate mortgages are now, in some cases, almost a full basis point, 1% higher than what they have been like 6-7 months ago, right? So rates have already gone up because fixed rates are based on bond yield. So those have already been impacted and gone up. But the one thing people have to remember is the qualifying rate that we use to qualify an applicant is the benchmark rate, the 5-year benchmark rate, which currently right now is 5.25%. So we have to qualify them either on the benchmark rate or the contract rate +2. So most contract rates +2 right now are less than the 5.25%. So the current variable, let's call it, is you can get right now, let's just call it 1.5 for ease. We're qualifying at 5.25. So even if the prime rate were to go up half a point over the next 6 months or 3 months or 2, or even over the next month, it's not going to impact what you're going to be qualified for a mortgage. So that's really the one misconception out there is like, I'm going to qualify for less. No, you're not going to qualify for less. It's going to cost you more from a monthly payment perspective, but it's not going to change what you qualify for, right?
So if I'm going in for a pre-approval and rates are at 2% and I'm worried about them going up to 2.5%, it doesn't make a difference in terms of affordability because you're already testing my income at 5.25%, right?
Exactly.
Okay.
Exactly.
So it just changes cash flow. So I hope that brings some comfort and answer. I think you answered that beautifully. What's better, variable or fixed? I mean,
Well,
historically, over the last
yeah.
10 years, variable's been a better option, but you know, we're in a different time now. What are your thoughts?
Yeah, that's a long question. Sorry, it could be a long answer, but I'll try to keep it brief, right? Um, what I like to do as a mortgage professional is obviously provide clients with choice. And what I do is I put my perspective on those choices, and then ultimately let the client decide. Because I think a variable rate mortgage is much like me recommending a certain type of investment, right? I could say, hey, Steve, if you got $1,000, throw it into Bitcoin. That's the way to go. What's Bitcoin like? Well, it's very volatile. You're up 100, you're down 3,000, you're up 4,000, you're down 10,000 in a matter of probably about 15 minutes, right? And you may say, well, that's not comfortable for me. That's against my risk. That goes against my risk tolerance, right? So the same can be said with variable rate mortgages, right? It may be the lowest rate possible you can get out there, but again, there is fluctuations potentially to that variable rate. So it may not be comfortable for the client. So I really want to provide perspective and provide options and let them know what I think and why I might go some way, but ultimately leave the client up with the choice. So I answer it this way. I always say, well, what's the spread you can get between fixed and variable, right? So let's arbitrarily just say 5-year variable today is 1.5, and 5-year fixed is, let's keep it simple, at 2.5. It's a little bit higher, but let's just use simple math. So it's a 1 percentage point difference in the two. So if I look at it, well, we don't know how many times prime is going to go up. There's talk it might go up 4 or 5, but let's just say it's never gone up 5 in a course of a year historically. It could, but it hasn't. So even though I'm taking a 5-year variable, even if it goes up 0.5 point in a couple of years, I'm still 0.5 point better than what a 5-year fixed is today. So when I look at it, I can take on that risk. Like, I'm comfortable with that level of risk because the spread is so great, right? So that's what I kind of try to look at, is really what's the difference between fixed and variable today? What's going on in the economy, of course, and what's the talk about what interest rates are going to do. But knowing that the spread is that high, I think you can kind of mitigate that risk. If it was only a 0.25 point different, then it may be a different type of conversation and what's happening in the market, right?
Okay, so let's say I'm risk adverse, and
yeah,
there's a 1% difference between the variable and the fixed, and Bank of Canada starts raising rates a bit. And, I took the gamble, I went variable, and I'm like, oh, well, Bank of Canada is kind of going up. Okay, well, now I'm like 50 basis point spread between fixed and variable. I'm getting a little bit nervous. What would someone do in that situation? Is there a solution?
A way out or a solution? Yeah, that's a great question. Most lenders will allow you to convert that variable rate mortgage into a fixed rate mortgage. So that's a good thing. As long as the term you're choosing is equal to or greater than what's remaining. So simply, I take a 5-year variable today, 2 years down the road, I've got 3 years left on my term, right? And now I'm getting nervous. I feel much more comfortable to convert to fixed, or maybe fixed rates have come down during that time, right? Because don't forget, fixed and variable are two different markets that create the pricing for them. So maybe fixed rates have come down and I say, now I want to convert it. So I'd have to take at least a 3-year fixed, a 4-year fixed, or a 5-year fixed to convert that variable rate into, right? So yes, there is a way to even take advantage of variable for now, with the opportunity of converting it down the road. The risk of converting it to a fix is obviously it could be a much higher rate than what you could have got on the outset of taking on that mortgage, right? So there is still risk associated with it, but at least it gives you some comfort to know that you don't have to sit in variable forever. If prime were to go up like 50 times, you'd be able to convert that well before that happened into a fixed rate mortgage.
Okay, awesome. I hope that brings some comfort to the people out there with a variable mortgage.
Yeah.
I don't see rates jumping up too much in 1 year. We don't want to shock, Canadians there, but I think this was great, Brian, and you're very informative. And this wine helps to work with a professional who understands the market and what's to be expected, right? 20 years of lending experience, doesn't come from anywhere.
It comes in handy for sure.
Yeah. Thank you very much, Brian.
Yeah, thanks, Steve, for having me, and look forward to some future talks down the road.
Absolutely. Take care.
Bye, guys.